Hello to the precious members of the Signals and of the Academy. This is a complete video in which I'm gonna be showing you how to identify the daily bias with very simple steps. You can do that every single week. And I'm also gonna show you what we are looking at and how we are identifying those precious breakers. You have been asking for a complete, let's say, strategy. It is complete for the members of the Academy if they scroll through my teachings step by step. But this video will include almost everything. And of course, I will go ahead and I will start from this new week, this previous week actually, that we traded, and we will go ahead together. And first of all, we will start by identifying the bias. Maybe actually, just maybe, just before we go through this week, let's take it step by step and start from the bias thing. So I'm gonna move all the way back here. Okay. And supposedly right here, we are expecting to see further retracement into those areas from the daily perspective, and we are expecting to see a break of the low. Or maybe let's start a little bit earlier on, and I'm gonna do every single candlestick until the current time. So pay very close attention. If we start with this candlestick right here, how you identify things, how do you know with mathematical accuracy what Wednesday is gonna do here, September 24th, this is Tuesday, and this current candlestick that closed, it swept the liquidity. It did grab the liquidity above the previous day's high, and it closed with a body below Friday's candlestick, as you see right here. So we swept liquidity above, and we closed with a body, the body is here, below the low of the previous candlestick. When that happens, you will be expecting the next day to grab the low. And you will understand the logic. I'm gonna do a myriad of examples until the current price action, and you will understand the logic. Let's see what the next day does. Very good. What did the next day do, guys? It grabbed the low of this candlestick, and it closed still with the body. It also closed with a body outside of the range. Theoretically, if you are not looking at anything else, so if you are not looking at the larger picture, the fair value gaps of the daily and anything else, this is what I'm teaching you here. Theoretically, if you would sweep the low of the previous day and if you would close within its range, within the range of the previous day with a body, then you would be expecting the high of this candlestick to be taken. In this occasion, if we look again only at the candlesticks, we did grab the low, but we closed with a body outside of the candlestick. So a body closed outside, hence you will still be expecting for the low to be grabbed. Of course, here you would take into account various other factors because you are already in a discounted area and you have tapped on an FVG of the daily. But let's go ahead and do this thing as I'm seeing it right now, and I'm gonna do a bunch of candlesticks which I cannot remember, of course, guys. I can remember 5 candlesticks, let's say the most recent ones. I have already forgotten, actually. Nice. This is precious. Our bias was bearish. We were expecting this low to be taken. Nonetheless, we swept liquidity above the high of the previous day and we closed with a body within the range of the previous candlestick. So we are expecting still to go lower in this occasion. So let's go ahead and do that. And yes, we went even lower. Now, again, if I'm not to judge of what I'm seeing on the left, where a retracement towards the upside is very possible, if you have closed with a body again below the low of the previous candlestick, you will be expecting the low of this candlestick to be taken. This is not taken. This is an inside bar. In this occasion, as I said earlier on, you would still be expecting the low to be taken when you create an inside bar and your bias goes bearish. But these are the situations where you take into account the fact that we are in a discounted area. So price can go higher from here, we don't know. We would know, of course, because we have the precious breakers. So the high can be taken as well on Nasdaq from my experience. And the high is taken in this occasion. So these are the only situations where you apply discretion. Since we start with the bullish movement now, again, maybe because we have tapped into a discounted area, you apply the very same concept again. We have broken above the previous candlestick on Tuesday and we closed with a body above the high of Monday. Hence, we are expecting the high of Tuesday to be taken. And this does not specify for how much it's going to be taken. Okay, this could be like that, or it could be taken and price could retrace. But with mathematical accuracy, we know that the high will be taken. Now I will show you how you can use those things. As an example, I will give you an example and we will continue. You could have, let's say, as an example, a breaker block of the 5 minutes somewhere around here or somewhere around here. And since with mathematical accuracy, we are looking to get the high of this candlestick, then we can trade that. Okay, until here. Okay, this is the way we are trading. But now I will go through those things later on. Now I will do a bunch of examples. I'm expecting the high to be taken and check out how many I will be doing correct. And the high is taken. Now the next day I will still be waiting for the high to be taken. And the high is taken. We close with the body again above the previous day. I will still be expecting the high to be taken. Of course, guys, again, I will tell you in real life situations we might have some breaker blocks of the 15-minute or whatever into a premium, so maybe we wouldn't be looking at that or we would be looking for some shorts, but judging from the candlesticks, I expect the high to be taken. And the high is taken and we close with a body again above, so still I'm expecting the high of this candlestick to be taken the next day. Let's see. The high is not taken, but what is happening this day? Right here, we are sweeping liquidity below the low of the previous day. We are tapping into this daily fair value gap over here, and we close within the range of this candlestick. So, I will be expecting still for the high to be taken. And the high of the candlestick is taken. Okay, the high is taken. Now, we took the high. This is a valid high as well, and we closed, and also this high of the previous day, and we closed within the range of the previous day. I am expecting at least this low to be taken in this situation, and maybe this low as well, we will see. And the low is taken. This is the fantastic thing. Look, the low is taken exactly right here. Again, we took the low, we also took the high over here as you can see, and we closed within the range of this candlestick. I'm still expecting a bearish move. And this doesn't happen. This is going to be one of the rare situations when it's not going to happen. Now we closed with a bullish body above the high of the previous candlestick. What are we expecting? We are expecting for the high of this candlestick to be taken. Let's see. Inside bar, the bias is the same. We are expecting at least this high to be taken and of course this high there as well. Let's see. The high is taken and we close back within the range of the previous candlestick. That being said, if I wouldn't have a bullish bias generally speaking here, judging from the candlesticks, since we swept liquidity above the high of the previous day and we closed with the body within, I would be expecting for the low to be taken, but all of those areas are covered. There is no FVG over here. I will expect the high to be taken. And the high is taken. First the low is taken maybe right here and then the high is taken. Those are the situations where we would have still a bullish bias. Maybe we have a breaker down here somewhere and you take the trade and you can target, let's say, 820 ticks. The high is taken. This is a very bullish candlestick, maybe it didn't close above the high of the previous candlestick, but its body is very close, we have a bullish bias, I expect the high to be taken. And the high is taken, and we close within the range of the previous candlestick. Peculiar situation because we have grabbed this high as well. This is a very peculiar situation. You can expect in this situation the low to be taken, of course, right here, because we have grabbed tons of highs, but the high is taken in this situation. Okay. Now, we have closed with the body above the high of the previous day. Nonetheless, now we are entering a little bit of a scary territory with what we are doing because we don't have the current graphs or the graphs that we had in the past. I remember there were tons of breakers right here within the daily FVG. Theoretically speaking, you would still expect the high to be taken since we closed with the body above the previous high, but the low is taken in this occasion. Now I will be expecting probably the low to be taken even though we grabbed the low and we closed within the range of the previous candlestick. And the low is taken. Okay, right here. Now, this is unknown territory to me. Theoretically, you would be expecting the high to be taken because you tapped into this wick, you grabbed the low of the previous candlestick and you closed within the range of the previous candlestick with a strong body. So theoretically, you're expecting this high to be taken, but we have entered a scary territory now. We don't have any other data and we are in a premium, but the high is taken. Beautiful. The high is taken, and after we are taking the high, we are retracing all the way down and we are closing with a body below the low of this candlestick. I will be expecting the low to be taken. Inside bar, we are still expecting the low to be taken. Another inside bar, same situation. Okay, this doesn't happen and we continue and we live some days. Of course, here I remember we were trading perfectly fine because we had the breakers. This is something that I cannot control with the thing that I'm doing right here. So now theoretically I would be expecting, if I am to do that in the past without having the real-time data, I would still expect now this low to be taken. I would wait for a couple of days and the low is taken and we closed with a strong body above the previous day. So now I expect this high to be taken and the high is taken and we close with a body. So I still expect the high to be taken and maybe the high over here. And this is happening. We are grabbing this high. We might be closing within the range of this candlestick. Again, I don't have any other data. We have tapped on a wick. Theoretically, with what I'm teaching, you would be expecting the low to be taken, but we are very bullish. As I'm seeing the candlesticks, I can still expect the high to be taken over here, guys, and there you go. And you see me, I haven't paused the video at all in order to see those things and do them, and the high is taken, and then we close with the body. I still expect the high to be taken, but we are taking the low and we're closing with a strong body below this one. So now this was a mistake. I will be expecting the low to be taken and the low is taken and we close within the range of the previous candlestick. So now we'll be expecting the high to be taken and the high is taken and then we retrace down and we close within the range of the previous candlestick. So I will be expecting, again theoretically speaking, the low to be taken over here. The low is not taken. I have entered an unknown territory to me right here, so I wouldn't do anything. Now the low is taken with, again, this is with the bias that I'm showing you right here, where I don't have any other data. If I have more data, of course here we took trades over here. Okay, we did take trades. Again, if we would have a strong breaker somewhere here, I do not recall, this would change the bias, of course, and this could already signify, theoretically, you would be expecting this low to be taken, but if there is a strong breaker of the past, you would be expecting maybe this to continue higher. This is something that I cannot control over here, and this is exactly what had happened there, and I recall correctly. So, pretty much, you do a combination of the breakers, okay, of the breakers with what we have right here, with what I showed you on how the bodies are closing. And now I'm gonna go again to this previous week from the beginning and I will show you how we did all of those things. Let me delete all of those trend lines. I don't want them over here. And I will show you how I expected all of those things to happen from my breakers. So the new week begins, and here we are. Since the new week begins, I will start from the daily time frame. Very, very, very nice. Now, the new week begins. Let's start from a lower time frame. First of all, what had I been expecting, guys, about this week, this previous week, which was from Monday, the 27th of January? No. Or it was from February, I think. Correct? No. Am I correct, guys? Yeah, it was the week from the 3rd of February. I got stuck a little bit there. What did we see here? Something that I could not control, of course, in the back test that I did beforehand. You see what we have here. That's why I activated my drawings again. We knew that we tapped on the point of control of a very old, precious 5-minute breaker. So my bias, as you recall, from the previous week, which was also a fantastic week, my bias, we caught those things right here, was still bullish, and we caught actually those things. This happened. There was another breaker here. Okay, so my bias, because of price tapping, that's why you use everything at the very same time on this old breaker, and we know how significant my areas are, your bias is still bullish. So you start the new week with a bullish bias, and I will leave the drawings for the time being. Okay, I will zoom in a little bit more, and you start the new week and you see this enormous gap. A gap again of 1,120 ticks. This gap again, 99% will be filled within the same week. This gap will be filled 99% within the same week. We already have a bullish bias and we have this huge, enormous gap. The bullish bias is times 2 now. So what you're doing, you're not doing anything. You are waiting for the next day to arrive. So you're not doing anything. Here you break above. You penetrate, of course, your breaker. You wouldn't trade right on the open. You penetrate this area and then you break impulsively above. Let's see if the area will be retested. Here you could already be looking on the 5-minute time frame and tell yourselves, do we have a breaker? A bullish breaker, because we are looking to buy? And the answer is no. This is not your bullish breaker. This right here is not your bullish breaker that you extend and it is tested. The bullish breaker, the way I'm teaching it, should have been this candlestick that I'm circling right here. This is the last bullish candlestick. Before the last down move, and the last down move refers to this move that grabbed the most recent liquidity. Believe it or not, the most recent liquidity is this one. But of course, in this occasion, we grabbed this one before the explosion happened. And you will tell me, then Chris, why didn't you use this one as your 5-minute breaker block? Because of the fact that there is no FEG on the right overlapping with it. No FEG, no breaker block. Very nice. Here, we don't have anything either on the 15-minute or the 5-minute time frames, which I'm using 99% of the times. Very rarely you will see me going to the 30-minute and the 1-hour time frame. Okay, so you proceed. You don't have absolutely anything, nothing. You want to go on the bullish side, and if you don't see what you want to see, you will not be doing anything. Again, is that a breaker over here? Let me delete those areas. Is that a breaker right here? No. Yes, it is the last bullish candlestick, let's say of the 5-minute before the last down move that grabbed the most recent liquidity, which was here, and of course you can claim here it is fine, but there is no FEG somewhere to the right. Very good. Now, we proceed. Okay. Do you see anything right here? You don't see anything. Very good. I'm still on the 5-minute time frame, and now you see something. Now you see something. Let me activate the old areas. I don't want to see something on the right. Let's go exactly right there. Oops. There. Very good. So you see, we were bullish. Look at this price action. Price came, revisited those areas and left. Very good. I delete everything again. And now you have this impulsive move down and a very impulsive move up on the 5-minute time frame. On the 5-minute time frame right here. Do I have a breaker block? Yes. Which one is my breaker block? Is it this candlestick? Is it this bullish candlestick? Or is it this bullish candlestick? It is this bullish candlestick. Why? It is the last candlestick before the last down move that grabbed the most recent liquidity. This is the most recent liquidity. This is a valid low. This low is lower than the low of the candlestick to the right, lower than the low of the candlestick to its left. Very good. Those things you start looking at when you have an impulsive move towards the side that you want to trade. When you see something like that, instantly you say, maybe I have a breaker. Beautiful. This is a breaker. Is it a breaker? Yes. Because it also overlaps with this fair value gap that we have right here. If a breaker overlaps either totally or partially with an FEG, this FEG could have been only that high, it is a valid breaker. You keep it, you extend it to the right, and then you go to the footprint charts. I'm going to the footprint charts. I'm not going to do it every single time here. And within the area of the breaker, I'm going to show you just this example. It is very easy. Within the area of the breaker, within the zone, I'm not only looking at the candlestick, the breaker candlestick, so I'm not only identifying this 556 that you see right here. I will identify that, but also other areas from previous candlesticks that appear here. And of course, this huge area within the gray zone of 1,460 contracts. Okay, this is an extremely huge area. This is the delta of this candlestick, the area of the highest volume and the highest difference between buyers and sellers, actually. This is the highest delta that we have over here, and the buyers have won the battle. And I can go ahead and highlight a point of control down here, which I'm not going to do because I don't care right now. Very good. At the very same time, I will go to the 15-minute time frame. And I will say, do I also have a breaker block of the 15-minute? Absolutely I do. I do have this candlestick, this bullish candlestick. Very good. Why is that a breaker of the 15-minute? It is the last bullish candlestick before the most recent down move that grabbed the most recent liquidity. And of course here we grabbed multiple liquidities, as you can see, and also this one, before price exploded. And you say, if I extend that to the right, does it fall either totally or partially? Does it overlap with an FEG? Yes, it does. This is a fair value gap of the 15-minute time frame. If I extend my breaker to the right, it does overlap partially. It is absolutely fine, even if the fair value gap would have been that much, or the other way around, it is absolutely fine. So this is a valid breaker. I highlight it and I extend it all the way to the right, and I leave it for at least 4 weeks, maybe even 2 months, depending on the experience you get on the charts and how you check out price playing out. Again, you go to the footprint chart, and now on the 15-minute time frame, within the gray zone that we highlighted, not necessarily only only the candlestick that I highlighted right here. Okay, but within the zone of our breaker block, we have the highest deltas, which are exactly right here. Highest differences between buyers and sellers and here. So this also overlaps to the left with another area. So those are my areas, and this area overlaps with the 5-minute situation as well. This right here. Okay. Now I'm very zoomed in and I cannot draw, but I'm referring of course to this area right here where both of them kind of overlap. First of all, I'm going to show you the reactions once again, even though you saw them live. Okay. I'm not going to go through other breakers. We have other breakers here as well, I think. No, we don't actually, do we? No, we don't. Actually, mistake, but let me show you the reaction. Very good. Real quick. There you go. And this is the trade that I called also, if you recall, which went only one tick below. One tick. On futures, you would be activated, or if you are afraid that you're going to miss the trade, place it 2-3 pips or ticks, whatever you are doing above it. It is absolutely fine. 1 or 2 ticks, they are not going to harm you in any way. Okay. And price taps there and it keeps going. Here there is a breaker, by the way. As I said, yeah, I did identify it. And there is a breaker of the 15-minute right here, which I think I did identify it at the time, but I did delete it afterwards. Okay, let's focus now on this price action before we move on to the next area that we have right here. Okay, and I want to make sure that I'm not going to delete anything. Very good. Now, how can you trade this thing? And this is the reason why our signal service is not like the other shitty services that say, I am entering here, bro, with a stop loss here, bro, and a take profit there, bro. Because every single person is different, guys. Furthermore, whoever says the word bro, make sure that you get them out of your lives instantly, whoever it is, okay? Brother is okay, bro is not okay. Let's go ahead now and talk about the specifics, let's say, of each individual, how each individual sees the market and what he or she wants to trade. Somebody might not like Chris's stop loss over here. He might consider this enormous, even though Nasdaq can move miles in minutes, okay, or even seconds. That's why we are giving the areas and you can choose from the following. You can either take this trade. You can do millions of things. This trade at the points of control and place trades. Here I would include both. You can place 3 trades here, 3 buy limit orders. Of course, you need to risk less because those 3 can make up, let's say, for one of the other trades. So if you are risking, as an example, 1%, generally speaking, here would be 0.33% or 0.3, 0.3, and 0.3, because you will make up anyways with the enormous win that you're going to get. You are going to be winning huge rewards to risks, absolutely phenomenal, but you're going to be winning way less. As a matter of fact, if I even proceed and show you this thing, this got activated. You got activated right here in the midnight. Let's say that you placed the pending orders, and within 12 hours, you have a 36-1 reward to risk. Even if you would be targeting again this high right here, you would have won a 23-1 reward to risk. Fantastic. Another way to trade this thing. You can place again from the first area a full risk, assuming now, guys, that you are risking 1% of the account, okay? You can place the full risk from the first point of control, stop loss below the low that we don't expect to be invalidated, and target whatever you want to target. At least a 1-to-1. You will be winning way more times than you will be losing, and 1-to-1 still works. Even a negative reward to risk would work because you will be winning way more times. But ideally, go for at least a 1.5 to 1 if you do that. Or maybe I would even suggest, of course, a 2 to 1 would be fantastic. Believe it or not, I'm not even going, most of the times I find myself that I'm not even going for the 2 to 1. I am a trader of the 1.3 to 1.5 to 1 reward to risk. I'm just winning a lot. I don't like letting my trades. What I like doing, this is another way that you can trade. At 1 to 1, you can close, this is I'm doing a lot actually, you can close, let's say, the 40% or even the way more. You can close the 60%, so you have bagged only 0.6%, but you have your fantastic bias and you can let the rest then run for a 3 to 1, okay? So you make a total of 3 times 4, 1.2, plus the 0.6, you have made 1.8 to 1. This is mainly how I'm trading, or even let this one run way, way more. This is another way to do it. Another way that I'm doing it a lot, especially with the larger accounts, is dollar cost averaging. Dollar cost average refers to the fact of you building against price action, against price. But it is not like I see many people doing it as gambling. I start and I buy here, and if price goes down, I still buy and buy. I start buying from my above 70 or 80% winning percentage areas from the points of control. And this is very similar to the one that I showed you previously with the tiny stop losses, that you placed 3 trades, if you recall, one here, one here, one here, and you split the risk to 0.3% on each and every one of those trades. What I like doing, the value that I'm gonna risk, the monetary value, the money is gonna be exactly the same. No matter if I do as I showed you here, no matter if I take the trade here with the stop loss below this area, no matter if I do the other approach and I place the stop loss below the breaker. I can start over here and place the stop loss below the breaker. This is another way to do it. All of those stop losses will represent the same value. So, those 3, if all of the 3 get activated and you lose them, in this scenario that you go for extremely high rewards to risks, let's take this scenario of those 3. Here, I will be risking a total, let's assume, of $500 if all of the 3 of them get activated. I will have lost this, I will have lost this, the third will activate me, and if I lose all of them, I will risk, or at least almost the same with 500. In the scenario where I will take one trade from the first point of control with a stop loss below this area and target whatever, this stop loss will represent 500. If I take the trade, one trade only, from the second point of control and the stop loss is here, now this distance is going to be 500. If I take it from the third point of control, one trade only, this is going to be 500, this stop loss. If I take it from the top and the stop loss is below the breaker, now we'll calculate it so that this is $500. If I take the trade from the second point of control with the stop loss below the breaker, now we will calculate this as a $500. And if I take only one trade from the third point of control and the stop loss below the breaker, which I never do, this will represent $500. What I am doing, I'm doing something very similar though to this high reward to risk approach, but I'm doing the exact opposite thing. I have way lower reward to risk, but I have an extremely high winning percentage. But I'm doing this thing. I'm saying, as an example, that I will place in this occasion, if this area from here until the low is enormous, I will say now I will place the stop loss below the breaker. So I will calculate the 360 ticks to be 500, as an example, dollars. As a matter of fact, with 2 micro contracts, it is exactly $360. Okay? So, assuming that I want to risk $500 here. And I want to place the stop loss down here. Now, what I will do personally, I know that I want to risk 500, which I'm almost never risking on this trade. This is a stop loss, no matter that I'm doing dollar cost average. This is the amount that I'm gonna lose. No more than that. So what I'm doing, I will place the first pending order right here, and I calculate that in a way so that this thing is gonna be the $180. So for $180 out of the 500, this should be with 1 micro. So 1 micro here, 1 micro I'm placing here, and until the stop loss, it is $180. I have another 320. If price moves deeper, I will place a second order here. The stop loss is gonna be at this very same spot. If I place 1 micro, this is gonna be $140. Very good. 1 micro here, if price goes to the stop loss, it's gonna be $140. Both of those now are doing $320 if my calculations are correct. So I have another $180 that I can trade from here in order to fulfill the 500. Very good. Let's calculate if price goes deeper. The stop loss is going to remain at the same spot. I will get activated. Very nice. 2 micros over here. So 1, 1, and 1. And this is going to be 100, let's say 50 or 159. Let's say $160. So you cannot calculate it exactly. Okay, you cannot calculate it exactly. This is gonna be a little bit different. 320 and 160 is gonna be $480. If I'm not mistaken at all, and I'm messing up right here with the quick calculations, 180 plus 140 plus 160. Wait, let's do it. 180 plus 140 plus 160, 480. So this will be my $500 risk. This is how I am trading personally. Now price, I'm not gonna overdo it. I'm just gonna explain this one. Price leaves after it has tested those areas. And let's delete the myriads of drawings that we have included over here. Actually, I can do that. Maybe. Can I do that? No, I cannot do that. Okay. We have taken this trade and price keeps developing. Our bias, even if we look at it from the daily perspective, is a bullish bias right here. Okay, we had closed with a body. Here it has printed yet another day, but we closed with a body above the previous day on Monday, above Monday. So we're expecting this high to be taken and so on and so forth. So over here now on the 5-minute time frame, what do I see? There is a last bullish candlestick before the last down move that grabbed the most recent liquidity. And you will tell me in this occasion, Chris, your candlestick should have been this one. You are kind of right. But this, in this occasion, also overlaps with a fair value gap. Where is the fair value gap? The fair value gap is this tiny thing. There is a fair value gap though, so you identify it. On the 15-minute time frame, do I have a breaker? Oops, excuse me about that. On the 15-minute, yes, I do have a breaker also on the 15-minute. It is this bullish candlestick here. Why is that a breaker? Because there is a low which got penetrated with the most recent move. Okay. And also this low. Of course, this is the last bullish candlestick. You extend it to the right. It overlaps with an FEG. So you leave it on your chart. And here I had it also on the chart, but because now we are in current price action and I saw it was not being respected anymore, I decided to delete it, and let's delete those. So now you are expecting a reaction from this breaker. Let's see. And off you go. Now look, over here you would have gone with this first approach. Over here, you should say, in my opinion, since you start positioning from the breaker, that your stop loss, it's only 170 ticks I would place my stop loss, and I placed my stop loss because I took this trade below this low. Not below the breaker, not below the point of control. And as we did that, what did we create on the 5-minute time frame? Another 5-minute breaker block. Because this is the last bullish candlestick, we reacted and we have the last bullish candlestick before the most recent down move, and I'm referring only to this move, of course, that grabbed the most recent liquidity before price exploded, and it overlaps with an FEG. This is your FEG. You extend that to the right. It overlaps over here. So you include that on your chart. And this is how we are pretty much building our story again and again. And as you have seen right now, before this week begins, I'm making this video on this beautiful Sunday. It is the 9th of February 2025. We saw a ton of reactions from our other breakers. I am highlighting all of the breakers, but I'm trading those that are towards my bias. This is an area that I can be expecting to be tapped onto, but of course I will check that out after some hours have passed and after I have confirmed some form of bias, because if I look at it from the daily perspective, I still don't have a specific bias. Well, I really believe in a bullish continuation personally, but I want to see our reactions from the breakers either here. Okay, so as I see price action right now, either I'm waiting to see price tapping here, either it can go deeper and react from those old areas, okay, over here, or in the worst case scenario, let's say, it can even maybe go deeper. I do not believe it's going to come deeper here. If this was tested, I believe price is going to react either from here or from this area right here. So people over here don't know where the hell to enter a trade. They have this whole area and they don't know where price is going to react. You know now, you have this tiny area and you don't want this to be invalidated. And then if price comes deeper and you have a bullish bias, if we have a bullish bias still, you will be going ahead and you will be entering here. You don't even need to look for shitty confirmations and the stop loss below this area or below the breaker or below the point of control, depending on what type of trader you are. So this is exactly the extended video on how we are doing things. And of course, I suggest that you keep participating in the signals as you are doing. The lifetime memberships, of course, I'm doing huge discounts. Many of you are already in the lifetime. I will have you here for a lifetime, guys. This is fantastic. I'm doing enormous discounts. Okay, I want us to be able to get payouts all together and of course not gamble, get consistent payouts, even if, those payouts will be small. It doesn't matter. Small and large is a very, very relative thing to what a person, an individual wants. So don't look at the stupid things other YouTubers are showing you, and let's keep doing business together. So this is gonna do it, guys, and I will see you all with our next video. Much love to all of you. Bye bye.